Ladies and gentlemen, you know what time it is. We are about to have our strategy meeting for the upcoming month of April. We have had a lot to talk about over the last couple of months. I think we skipped a month, and that was because we were testing out some new software. We are recording this, so don't have any fear that you will miss something. We'll have this one archived for you. But as always, we're going to bring our trading team in, and we are going to kick things off with Brett Manning. You know him as Chart Trader, and as usual, we will start with the macro perspective. And Brett, I want to get your take on what's going on with the rotation and rebalancing trade. The funniest thing, Brett, was within minutes of one of our listeners writing in asking you about when this whole rebalancing takes place and when it might be finished. You indicated, oh, it happens on around the 25th of each month. Well, guess what? Within a matter of minutes of your post, we hit the bottom in the S&P futures, and guess what? We haven't looked back ever since. I want to know, how did you do that?
Well, yeah, it wasn't quite intentional, but I did suspect that some of the weakness we were seeing yesterday morning was really about an intensification of that dynamic. But I want to start just panning back a little bit to put everything in perspective. I think you can get a sense of, so the rebalancing trade is happening inside of a rotation trade, which is a different dynamic. And to give people bigger picture perspective, I think you start with one fact and one contrast. So the fact is there's one thing that everybody agrees on right now, and it's not necessarily about an asset class or an investment theme. It's just the basic idea that we're going to see a really strong economy over the next year. And that's really the kind of basic point. And that brings in a huge contrast. So on the one hand, 90% of major money managers right now believe inflation and economic growth will outperform over the next year. That's the highest percentage ever. And this is something Gavin and I talked about a little bit in our Sentiment and Flow show. So it's the highest percentage ever. But on the other hand, while you have this sort of record level of confidence in growth and inflation, you have a Fed that's saying that it won't hike rates for 3 years. And I think so. I mean, the way that I look at a policy statement like that is I think it's kind of beyond the horizon of view in the first place. Like if you're a sailor, I don't know if you've ever sailed before, but you know that the horizon is basically you have 5 miles of view before the curvature of the earth prevents you from seeing any further. In my experience, analogous to that for policymakers is about 6 quarters. So, and that's impeded by like haze and mirages, right, and weather. So basically saying that it's going to be 3 years from now for the first hike is like saying never, pretty much. And that contrasts with money managers having this sort of record level of confidence in terms of what the growth and inflation outlook is over the next year. And, that steepens the yield curve because the Fed is in control at the short end. The market is in control of the long end. We've seen some bad bond auctions, especially 7-year, and again yesterday, 7-year. But just this sort of rising trend in interest rates at the long end and the Fed anchoring the short end, and that's driving a rotation, right? I mean, that means basically the outperformers are going to be leveraged up companies with assets in the ground, commodities. It's going to be financials because the steepening of the yield curve gives them a wider net interest margin, and you've got a cash valuation problem in terms of the discounted cash flow model for speculative technology companies. So money goes from one to the other, and that's what we've been seeing. And that makes perfect sense. Investors want to see CapEx investments. They want to see increasing leverage. The return on invested capital put to work now is for the first time in maybe 15 years believed to be better than some imaginary point in the future, right? So everybody wants to be a borrower. Nobody wants to be a lender. That drives up interest rates. You got strong expectations, tons of stimulus, no policy risk, demand rising up and down the supply chain. And Gavin's going to talk about this a little bit more, but the supply chains are in bad shape because this is such a contrast with where we were a year ago that there's been no sort of second derivative investment in developing new production capacity and developing the logistics to support a sudden complete transition in terms of the demand picture. So we've got supply chains just in tatter. So that's really the backdrop. And then, like you mentioned, shorter term, that has led to a really clear trend down in the bond markets, up in interest rates, and stocks have basically held up, maybe advanced a little bit over the last quarter, and that's led to one of the biggest rebalance trades that I think I've ever seen, because it's really the first time we've had this kind of complete breakdown in the bond market with the stock market that can hold up in a long time. So there's a huge contrast in performance, and most of these fixed weight or balanced funds, pension funds, a lot of sovereign wealth funds, they're in a situation where they've got fixed weight charters, so they need to hold 63% stocks or whatever, relative to 30% bonds and 7% cash or whatever the model is. Different charters define it in different ways, but there's a level you need to be at when you're going to turn the page from one quarter to the next. And when one of those assets declines a lot, the other one holds up or rises, then the value, the weighting in your portfolios changes massively, and you have to rotate toward the end of the quarter. And like you said, it peaks on the 25th. Generally speaking, the 25th of the third month of each quarter is going to be your primary kind of zone of greatest impact for rebalance trade. This is maybe the biggest rebalance trade we've seen in a decade. I think the numbers that I've seen have been somewhere roughly between 100 and 200 billion in capital that needs to go from stocks to bonds in the quarter end. And I think that really peaked yesterday morning. So yeah, I think that was a material factor, and it really it was interesting the way that it technically played out right around the SPX cash 50-day.
So when I'm looking at what we've seen in rates, and we've seen a little bit of dip off the highs over the last couple of weeks. I think we were trading in the 175 range in the 10-year Brett. And if we did have a lot of funds buying these bonds, driving rates a little bit lower, should we expect to see them float back up now that the rebalance is maybe over?
Yeah, I mean, I think, well, so I wrote this morning, I think we're in some kind of lateral consolidation. So I think, so there were two factors that came together really nicely, and I wrote about this late last week, midway through the day after the Fed, I guess it was Friday, right, when the news came out on the SLR expiration. And that was thought to be this huge risk for the bond market. And so we broke knee-jerk right around the open, a little ahead of the open, on the news that the Fed is going to let it expire. And supposedly that's going to drive this big supply to come into the market from banks who had been holding bonds and they no longer can because of the way that it's checked at the Fed. So that was supposed to be this big factor, but it looks like it was priced in advance, or like some analysts suggested, was actually nowhere near as material a situation as had been played up on Bloomberg. But when you saw that, whatever was the expectations around that knee-jerk to the downside in bonds, to the upside in rates, by midday Friday, we'd taken all of that back. And if you're headed right into this rebalance trade, so you overshot initially to kick off this period, and then you've got these 3 or 4 days of intense rebalance. So I think, yeah, it's been a huge factor. But so when I started, the picture that I outlined, that is a force for rising rates at the long end. This contrast, this idea that, the Fed is going to keep policy indefinitely loose, no matter what the data say. And the vast majority of capital in the market believes that we're going to see a stronger than expected outcome in terms of economic growth and in terms of inflation. And so, yeah, I think the pressure upward in interest rates is fundamentally super supported right now. And we've got this little window of a series of days that are passing that would provide the best possible chances for a bounce in the bond market and a move back in rates, and we're seeing the lateral consolidation. So I would say we could have some complete transition in terms of how people view the growth outlook. That's possible. I think that people are kind of looking for that a little bit, and we saw some of that when we, heard the possibility of Germany doing like an Easter lockdown, and what if, there's variants to get a little bit out of control with the virus? What if we've got this assumption of this great reopening, and it hits an obstacle, and everybody's positioned the other way? That's a risk, but so far there's no real tangible sign of that. And if anything, we're doing better than we expected in terms of vaccine distribution. So I think everything still kind of is this picture where you're going to see this confidence in growth and inflation, and that means, again, everybody's going to keep wanting to be a borrower and not a lender. So after we get past this window, yeah, I would say rates would probably move back higher.
Well, then is a layup short bond trade, or is that trade too crowded?
So there's a crowd there. I would prefer to see some kind of headline catalyst to liquidate short interest and then trade into that. But I think that that's a very strong premise.
All right. Well, let's bring Scott into the conversation here, because you are an expert at identifying relative strength and weakness. And as far as sector rotation goes, Scott, what are you seeing out there as we head into the new quarter?
Yeah, just to build off of what Brett was just talking about there. I mean, he hit almost every single one of my talking points as well. So I think I think every one of us can pretty much agree with exactly what he just described there with the intermarket relationships. But when you narrow things down a little bit more into the actual sectors and the industry components, um, let's just say it's fickle at best these days. The market, was really easy early on this year to start off 2021. And things started to get a little hairier in the latter half of February and then into March here, especially with the NASDAQ and a lot of leading growth technology names coming back in below their 50-day moving averages. So the market's been in somewhat of a rotationary process going on here. But even then, once those themes become somewhat apparent, they basically run out of steam, and then they start coming back in, and the rotation continues. So it's just very easy to get chopped up in this environment, and I just would have to caution anybody that it can feel like death by a thousand cuts if you're not adjusting to the proper conditions right now. For me, it's been definitely cutting back a lot of my trading style, cutting back position sizing, and just kind of taking things a lot more lightly the last few weeks because of this choppy environment. But going back to sectors, basically, if you look at the last quarter or so, we've seen a lot of strength amongst the energy space, a lot of strength amongst banking and financials, basic materials, industrials, transports, aerospace and defense. Multimedia has been really strong, and even you could throw some housing in there as well. So there is these pockets of strength in the market, groups that have basically trending higher over the last couple of weeks, good bases of forming along key support levels and moving averages, and then they're launching higher. So those are really where the money seems to be flowing into in that regard, while it comes out of the more speculative technology names recently. A few retailers, apparel stocks can also be thrown in there as well. But for the most part, we're seeing a lot of the hot momentum names that we saw early on to start this new year, from cryptocurrency to the marijuana stocks to electric vehicles, alternative battery energy sort of plays. All that seems to be losing a lot of its luster. Let's throw SPACs in there as well. SPACs have also been suffering after a lot of their hype to begin the new year as well. So it's been a pretty rotational area. So I think that's the theme right now. And again, as a trend follower, I'm going to basically ride those themes out until something apparent comes along to change them. And I don't really see that happening. And that's really it. Otherwise, it's like, just kind of following, the markets here, following things day by day, and it just keeps changing. It's changing very quickly, very rapidly here. It's going to be a very interesting next few weeks going into a new quarter. I think I want to say one thing here too, because I know you want to go to another topic here, but the hot group here this last couple of weeks has been these non-fungible tokens, NFTs, and I think we should probably touch on them a little bit at various aspects here and give our own little opinions on those.
Well, that gives us an opportunity to bring Craig into the conversation because he is who I was going to ask about these NFTs. But first, before we get into that, Craig, I want to get your thoughts on when we do see a rotation, we get massively hit in the technology space. So I want to talk about valuations, where you see them. Is it opportunistic to buy the dips on these? Are you staying away? What is your take on that whole environment? Did we lose Craig? Trend Tracker, you with us?
He probably thought I was going to talk longer than I did.
Oh, well, we'll get back to we'll get back to him on that.
I know Gavin's been doing a little bit of stuff on NFTs. I don't know if you want to chime
Gavin,
in a
why
little
don't you
bit.
jump in? Do you have anything to say about the NFT environment?
It's crazy. I haven't been doing that much stuff. I know Craig has been looking at it. So here's Craig. Craig's back.
All right, Trend Tracker, you have the floor. least.
Maybe not.
I
Well, let me
think-
just
Alright,
let me set it up, Gav. So basically, an NFT, because I'm and anybody can correct me if I'm wrong on this. It is a fairly new topic. It's a non-fungible token. Basically, what I've read about it, it's a digital certificate of authenticity is the best way I've come across it, and it's been equated to almost like old school baseball trading cards. So, say for example, you have Derek Jeter, one of a fantastic baseball player. You can't actually own Derek Jeter, but you can own the baseball card, which has all his stats, and there's as a collectible item, there's going to be value in it perceived by certain people, and people are willing to obviously pay for these, pay up for that baseball card, and they are willing to trade it at certain points, for a profit if they can. And that's basically what my understanding is that, no one, you can't really go out and own like the Mona Lisa. I'm pretty sure, I don't even know where it is. I assume it's in some museum right now. I can't think of it. It's in the Louvre. I don't even know where it is. But anyway, you can't actually go and get the Mona Lisa, but somebody can actually own the digital authenticity certificate of it. And that would be a tradable, thing to pass around to kind of say you have the rights to that. So some of this seems to be a little out of control. I've seen various examples of people, selling their first tweets out there. I don't really know why anybody would see that, but again, this seems to be like more of like an artsy sort of thing where value is in the eye of the beholder, and that's basically where it is. Now, some of the interesting ones out there that I've seen would be more in the music industry, more in the gaming industry. Gaming has been really hot lately, and I think people trying to own, I don't know, some sort of rights, or not necessarily rights, but just more of the intellectual property authenticity of a particular game, like say Fortnite or Madden or something like that, and or a particular song. I guess that can be an interesting source of alternative investments for some portfolios. So I don't know if anybody wants to build off of that or correct me where I'm wrong.
Well, we can try Craig one more time. He may be having headset issues. Craig, are you able to participate? All right. It looks like
it doesn't look like he's working.
yeah, it
there,
doesn't look
Jim,
like
so-
he's got some technical difficulty. So we apologize for that. If he
Yeah,
grabs a new headset, we can have him jump on in, but if not, we'll just table this one. He did put up an article. I want to suggest to check out Trend's post under his ticker TREND, where he talks about one of the venture capitalists put together a piece in which he put a link together to give you a little bit of some color on the NFT market. So with that said, encourage you to check that out. It's under TREND at 11:17 is the timestamp there. All right. So, Gavin, since I got you on the line, let's talk a little bit about financials, because the Fed came out and reduced their restrictions. I think this was widely expected, but financials are off to a nice start today. Got some boost there. Do you expect this to continue? We've seen some decent pre-earnings reports from the likes of Jefferies and Credit Suisse. So is this getting us off to the right direction as far as earnings season goes for financials?
Yeah, it's definitely setting us up nicely on that front. We're not all that far away from when we should be expecting the earnings reports to hit. Just taking a look, the week of April 12th to the 16th. That's when we start getting a number of these names out there. See, JP Morgan, Goldman Sachs, Wells Fargo, they're going to all be out on the 14th, and that's going to kick us off for earnings season. But there's been a lot of positives for the banks. And, we could first take a look at the SLR decision by the central bank, which on the surface was a negative for the banks, but I think it might have been a vote of confidence in the current setup of the balance sheet by the Fed on how these banks have set themselves up, and that's pretty notable there. They're not going to have to raise any sort of capital in order to partake in the T-bill bond buying. So that's a positive for the banks and for the overall markets. And then you see the Fed doubling down. Not only did they allow that exemption on the SLR to expire, but they're also going to allow banks to raise their capital return programs, again pointing to the idea that they see these institutions as extremely well capitalized. Moving on to the next piece, we got the investment banking units. And as you were just saying, Jim, Jefferies and Credit Suisse have both come out with really strong IB reports. I mean, you take a look. I posted the Jefferies report a couple of days ago, and they just had record revenue, record growth. Fixed income was up, I think, 140% year over year. Equity was well up. And Credit Suisse, too, which is a European operation that really hasn't seen nearly as much popularity as the American institutions, they posted a blowout IB number. And when you take that into consideration, then you're looking at the overall traditional banking, and you got those rise in yields and the steepening of the spread. That's going to make them even more profitable. This is a good chance of being the most profitable quarter for banks that we've seen in the last couple of years. And then we go to the final part, and that's demand for loans. And that has dragged a little bit. That could be one area of concern for these names. But we know that there's pent-up demand. We've continued to see issues there. Certainly there's the global supply chain issues that are causing a little bit of a glut. But that is more of a push-off than a erosion of demand. And I think that's a key distinction to make. So I think that these banks remain pretty solid vehicles to own in a choppy market. Now, I know the first thing people are going to ask is, well, why is Jefferies selling off after a pretty strong quarter? And that is certainly a viable question and something that we'll need to continue to watch for Goldman Sachs and Morgan Stanley, the idea that maybe some sort of peak cycle is in. I think that would be the wrong way to go about looking at these, and I'd be eyeing up any sort of pullbacks or any weaknesses as a buying opportunity. So we're going to I continue to hold Bank of America and Citigroup in this space. But if you're looking for a safe area to ride out some of the choppiness that we're seeing in the markets, I certainly think that the financials are one to go because they got a lot of tailwind here.
All right. We've also seen a couple of off-quarter reports from the likes of Nike and FedEx, some pretty heavyweights when it comes to color on the economy, and they were actually pretty good. So should we be looking at these companies as a read-through for what to expect for the upcoming earnings season? The quarter end is just a couple days away. That goes to you, Gavin.
Yep. We see the early theme that's playing out here for earnings, and I thought the Nike FedEx results were right on what we're going to see from a lot of these names. And that is Nike missed some of its expectations because of the delays in its supply chain. They are a big global supplier, so the Suez Canal issue, for instance, is going to hit a name like that and really probably lead to some disappointing Q1 earnings that we're going to see coming up. And it's going to be really important to kind of ascertain why companies might miss a number. And one of the big things is going to be, did shipping costs offset that? And if that is the case, then you want to see how long these shipping costs are going to be in place and how much that's going to affect earnings moving forward. I think we're going to see that for, say, like a Walmart or a name that has a lot of imports that are included in on its sales. And that's going to lower some of the valuations of these names because of those rising costs. But then on the flip side too, you're going to want to keep a close eye out on overall demand and whether or not a company, say, misses a top line number because of shipping delays or just because there's simply not enough demand being there. And you're going to want to be able to differentiate between the two. But what I think it's going to do more than anything is set up some of these names to see a little bit of sell the news reaction, and that you're going to want to set up for a buying opportunity for later on in the year where you're going to see some of these issues ironed out. And a couple of the names that I've been looking at. I mean, Jeffries would be one instance where I know it's not due to any shipping containers or anything like that, but where you're kind of getting some of this sell the news reaction to some of these names. You want to set up a list for yourself, like Jeffries at 30 would be a perfect example. Another name that I saw post really strong results and didn't get rewarded, AMBA, AMBA, coming in as some key support levels around this 90 level. So you want to start putting together lists like this. Splunk was another one that was jumping off to me. It's coming in, trying to find support around this 130 level, starting to see some positive commentary changing on these news. They recently reported a decent earnings for them, but continue to just see selling pressure in light of that. So, these are the names that you want to start putting a list together. Five Below would be another one that saw blowout numbers but didn't really break out. Now it's starting to edge higher. So getting a list of names that have been blowing out earnings and being ready to act on them when they either come into support or when they start breaking out is going to be a key Q1 theme, I think.
All right, Gavin, and I'll probably circle back with you if you have some other names that you want to touch upon, but I want to bring Scalp Trader into the mix here. And Damon, you are, the authoritative figure here on the SPAC environment, and we want to talk a little bit about the carnage that we've seen lately and the way you've been playing it. So talk a little bit about it, what's caused this weakness, what's caused people to jump ship in the SPAC space, and how you're going to play it.
Okay, so I guess the first thing I'd say is don't panic. Don't panic. This is to some degree good. We've been talking about just the ridiculous supply of new SPACs coming to the market, and there was going to be a price to pay at some point, right? And our overall strategy, my strategy, had been to lock in profits on names as they rose, recycle that cash into pre-deal SPACs that were trading at 1050 to 1150 or so, right? So small premiums in names that have the potential to announce deals that could potentially drive the stock up 30, 50 to 100%, which is what we've been seeing basically through December, January, February. And then suddenly the SPAC market hit a wall, as markets started to turn south, money started to flow out of momentum names. That included SPACs. The SPAC game had just gotten way too easy. So where we are now is you're seeing money. Hedge funds had started to put on leverage to engage in SPAC speculation, particularly at the IPO level. So essentially what they were doing was taking on leverage, putting money into dozens of different SPACs, which was aiding the supply of new SPACs coming to market. And what they're able to do is once the unit split, you can sell the common, and the common was often popping to 1150 right out of the gate. So you're making a profit on the common, but then also keeping the warrants. And the warrants in many cases were trading up to $2-3. So something you bought for $10 within basically the first day of trading theoretically could have been worth $13. And so that trade was just too easy, and that's one of the reasons we've had literally 300 SPAC IPOs price in 2021. Think about that. 300 SPAC IPOs just year to date. We have about 550 outstanding SPACs looking for a deal right now, including the SPACs that priced last year that have not found a deal yet. So where does that leave us? Leaves us in a situation where now you can actually sit back and be extremely selective. Instead of spreading money out in pre-deal SPACs and having 2 years for those companies to find a merger partner and you having to wait, but you wanting to have participation in that upside whenever it came. Now, essentially what you can do is kind of back away from the pre-deal SPACs and focus on the SPACs that are actually announcing deals because they're not moving. In fact, they're moving down. Everything is getting sold for the most part. So we're in a situation now that if there is a SPAC that announces a deal at an attractive valuation, you may very well be able to buy that SPAC at 1020, 1030, 1040, 2-3% essentially premium to net asset value, to your redemption value. You may be able to buy those warrants for $1.50, $2. And so think about that. You could participate in something that has meaningful long-term upside. Just think about the warrants, for example. You can buy a warrant in a name for $1.50 and say over the next year or 2 years, and these are 5-year warrants typically. Say over the next 2 years, that stock goes from say 10 to 40, and that's not completely unusual. We saw a number of mini SPACs do that over the past year. But now I think the valuations will become even more attractive, because unless investors vote in favor of that SPAC deal closing, the SPAC sponsor may have to give the money back. And the pipe deals that are supporting these large mergers are not coming through the way they were. Before, the pipe deal was free money for the investors. Now, with the SPACs breaking $10, it's no longer free money. So I guess what all that means is that institutional investors have become far more selective in terms of which SPAC sponsors they're willing to support. And so they're doing the analysis and saying, hey, the valuation needs to be attractive, the company needs to be attractive for us to make money on this thing, and for the investors to actually bid it up and want to participate in this name. So I guess the reality is, I'm kind of being long-winded here, is I think there continues to be tremendous opportunity in the SPAC space. It's going to require a lot of patience. It's not a trading game such as it was just a couple of months ago. It's something that will require patience and research, and that's what I do. That's what I really enjoy, and I think that is where you will make your long-term upside, where you will literally find opportunities to make quadruple-digit gains in some of these names. So, questions?
Yeah, the question is, which ones are those? Which ones are you diving in the research right now?
Well, so today doesn't matter, right?
Well, you've got to have something in the pipeline, though.
Yeah,
I know you.
I guess I just kind of really want to emphasize, right? Today doesn't matter. Yesterday doesn't matter. Last week doesn't matter. It's about patience, and it's about the fact that there are 550 SPACs out there looking for a deal. So it's all about process. And so, so today I mentioned, was it GNPK? That came at a very intriguing valuation, and that's something that that could work. SPNV, which I've been accumulating this past week, I like that one. I think that one could work higher. But the reality is that I'm just sitting here watching these deals every day, and I know that I'll have to sift through 20 deals to find one that is attractive long term. So again, it's process and thinking about making money, but not necessarily today or tomorrow. The time frame doesn't matter, right? So one of these SPAC deals could literally make 5 years worth of profits, right? So today doesn't matter, tomorrow doesn't matter. It's just about the process and being disciplined and patient.
I thought the WeWork SPAC might generate a little more buzz than it did. And you didn't even mention it today, so there goes my assumption. But so, and you giggle at that. So where was I off base, or where was the rest of the market off base?
Yeah, it's WeWork. So basically, you're investing in a company that is leasing out real estate space on a long-term basis and charging short-term rates. I don't know. I don't necessarily love the business model, but also
can I just interject and say that they have definitively proven that their model does not work, and then they went to the market.
Yeah, no, I agree. And there were lots of copycats when WeWork was taking off. Its valuation was launching when it was a private company. I think the valuation got up to, I don't know, $50 billion, right? And so there are a lot of imitators out there who've since pulled back. So I don't know. I just don't know how this business model works, to be honest. So it was surprising to me that this deal was actually able to get done, and it's not something that I have any interest in at all.
All right. Are there any other names on your shopping list that you're looking at? Any SPACs you're looking to buy back?
Well, so again, it's process. So we talked about NPA yesterday. I bought some of the options, longer term options in NPA, and so a name like this, if their business plays out as projected, and you can model this name against other, essentially probably would attain wireless tower valuation. So you can model this name if you're based on the projections and if the plan plays out. This could be a $80 to $120 stock, right? So that's a name that I think the warrants are interesting. I've been buying some of the options. And so I guess my overall plan is really just to kind of look at this as venture investing, and what SPACs offer, unlike IPOs or private capital, are these warrants. Yeah, I really like the warrants feature. You can buy something that has a 5-year expiration. If you buy it at $1.50 or $2 and the thing goes to $50, I mean, you've made quite a significant sum of money. And it's, again, like I've participated in some of these warrant plays that have just delivered astounding gains. So this process can be fun. It's got to be painful. I mean, so many people were participating, so many people were experts, and that's when you know something bad is about to happen, right? And so now there's just the interest is gone. Like a lot of these speculators and talking heads that were hyping SPACs a month ago, 2 months ago, they've disappeared because they're not long-term patient value or distressed or venture investors, right? They're really GameStop traders who are, call themselves fundamental traders who are looking for some crappy new EV or battery play to tout, even though those are the exact companies that will end up going bankrupt, right? So you look at all of these EV plays, I say 90% of them will be bankrupt, right? So you didn't see me hyping those, other than for a few of them I put on short-term trades, but I think all that stuff is just trash, right? Like, people were focused on the wrong thing, and now that you're maybe starting to see the right thing come to market, there's no interest, which is good.
All right. Gavin, I want to bring you back in because we were talking about shopping lists with Scalp Trader here. I know you have a few other names that you'd like to toss out at us.
Yeah, I guess quick question for Scalp, and this will work into my shopping list. So, Damon, if a stock is trading below the $10, if a SPAC is that basically kind of like having a option that's ready to expire? At that point, are people just going to demand their money back and get redeemed for the $10?
Exactly. So if it's a pre-deal SPAC, I mean, it's not unusual. Historically, pre-deal SPACs have traded at a discount to the redemption option. So they've traded $9.50 to $9.70 in some degree, depends on where interest rates are, because of the opportunity cost of having that money sitting out there for up to 2 years until a deal is identified. So it is not unusual. I would say that most pre-deal SPACs now are back to the 10 or sub $10 area. And so that's not unusual. For a company that has announced a merger, it typically takes 2 to 3 months for the merger to close. And so up until that merger vote, you have the redemption option. Most of those SPACs are still, even the bad ones, are still trading around 10 or slightly above 10, and there are a few that are trading below 10. So if you own a SPAC that is going through the merger process, the the vote hasn't occurred yet. The redemption option is still available. If you owned it at 980, then yeah, you can actually go in and vote to redeem your shares, and you'll get $10 plus back. So it's $10 on most SPACs, $10 plus the accrued interest. So sometimes that ends up being $10.06 or $10.10. So just have to typically once they announce the merger, they'll publish information within the next few weeks on exactly the exact redemption value of the trust.
All right. And last, APPH, is that one that you've come across?
APPH, is that one of the
Harvest
farming?
It's the Appalachian Mountain one they're doing out of farming equipment.
Yeah, I have come across that one. It's not really on my not
Okay,
my
fair enough.
area, not my area of interest. So it could be great, but just not an area that I focus on.
Okay, no, fair enough. All right, Jim. So some of the other recent earners that have been kind of falling on my list, just to give another list of names for people to watch. This Dream Finders Homes. This is coming into some support right around this 21, 22 area. This is a perfect example of a name that had a pretty good earnings report and is just getting chopped down lower. Certainly the rise in interest rates, I think, was a little bit of a fear for the housing market, I suppose. But when you look at the rest of the housing plays out there, the home builders really just kind of been chopping around near the highs. We haven't seen too many that have just gotten beaten up and knocked lower. But this DFH definitely falls into that realm. So that's another one that I've got on my radar post earnings, kind of falling into that realm. Signet Jewelers, they had a big quarter. Demand continues to be in play, but they ended up selling off going into following their earnings. And this is kind of the type of chart that I'm looking for here, where it fell off post earnings, came into support. Now it's bouncing back and making a push higher. And I think this one as well, if I'm not mistaken, has a pretty low float and high short interest. Yeah, it's a 50 million float and a 10% short interest. So Signet, SIG, is another one that I put on the radar. And then some of the tech names and the Chinese tech names that have gotten beaten up. I know Scott and I talk a lot about this, but MongoDB, that's one that's fallen all the way now to its 200-day moving average and is starting to look pretty attractive here. So that's another one that's on my list. On then just looking at some of these Chinese names, they've just been decimated here. I think Tencent Music would be a perfect example. Look at that. It broke out after earnings and then just got crushed, reversing lower and coming into the 200-day moving average. You're seeing a lot of that puke type move in these Chinese names around concerns around regulation. IQ would be another perfect example of one of these Chinese names that is just getting decimated here. They also have the potential headwind of the Chinese central bank tightening, but I think when everyone's kind of looking at different names and no one's really paying attention to these Chinese names, but I feel like a lot of them have had that puke moment where you could start eyeing them up for some trades. So, these are a few of the names that I've got on my list that I'll be talking about in the weeks to come.
All right, Gavin, I think, have we covered everything that we wanted to in the equity space for now? Is there anything else that we haven't checked off our list of things? I don't think so. But if we do, feel free to jump back in after this. I want to touch on a different market, and that's the oil market. So we're going to bring in Brett Manning, who is coming off a pretty nice trade over the last couple of days. You threw this one on after hours, and you say you got lucky, but you get lucky a lot, so I'm not going to call it luck anymore, Brett. Anyway, so you got about $4 or so on this particular trade. So let's talk about where the crude market is going, how the Suez Canal disruption is going to play out in this, and should we see higher price? I mean, you would think fundamentally that would cause the prices to go up, but what say you?
So, yeah, I really hope other people got to enter this with me, because I started talking about this 5730 area like 3 days before it hit, and the setup is basically so it's a reliable setup, particularly in the commodities markets, but it takes a little bit of Elliott wave background. This is sort of the 4 of 3 of 3 level. So basically, when you get a sideways range in a commodity, there is usually some kind of pivot point before the base of that consolidation. And in this case, we're talking about, I think back in mid-February, we had a 2 or 3 day consolidation, and that's sort of the lower degree wave 4. And then we started to move into the wave 5 of the 3 of 3, and we formed this lateral range, so we're sort of in the 4-3. Oftentimes, you get this overshoot of the range floor of that larger degree 4, and you're going to touch this area, which is the 4 of 3 of 3. And the 3 of 3 of 3 is this impulse on impulse on impulse. So it's the most directional stretch of the trend. And we got that from basically late January until mid-February. And that's the area that doesn't get violated. So when you overshoot the range floor, and the range floor is really formed in March and really along that 59 level. And the really nice thing about this from a technical standpoint is the 50-day on the continuous contract was coming up right through that same area in 59. So the beautiful thing is you breach the range floor, you breach the 50-day, and you get this kind of technical outflow, and it over-exaggerates the downside. And then you've got this nice other pivot level sitting there about 150 ticks lower, which is this exhaustion point of the overshoot of the selling that's triggered on a technical basis. So it's a puke out, and we saw that into that area, and that area is just sitting there like this perfect little basket. And so I wanted to highlight that, and I highlighted it a few times, and I know that it was probably a tough setup to catch. I just want to point out the dynamic that was behind that. So that level, that area held again on a difficult and really concerning retest yesterday, which I thought was I didn't think that it would be getting back to that area, but when it did, it looks like we stabilized around it. I don't really put too much faith in the idea that this is about the Suez blockage. I understand that that's an immediate concern. I understand we don't know where that's headed, but the market is going to price according to larger time frame dynamics than something that's a several day backup, because this doesn't seem to have the possibility of causing a kind of super spike where you start to get commercials hedging, like airlines who have obviously a forward exposure to crude oil prices because the jet fuel prices are perfectly correlated. So they would have to start buying crude oil futures like crazy if they thought somehow, there was going to be some kind of 3-month blockage there and nobody was going to get any oil. And I think that scenario just isn't viable. So I don't think that really in and of itself is something that can turn into this sort of commercial hedging squeeze. So with that really kind of out of the analysis, you've got, I think the more important dynamic was, it's the long-term context, right? The context is we haven't done any development of extra production capacity pretty much over the last year. Chevron just came out 2 weeks ago and said they're going to keep their 35% investment cuts in place for 5 more years, right? So the very little is going to be spent on developing new production capacity. I doubt Chevron's that different from what Exxon's going to do on down the line. So they've had such a balance sheet hit during the pandemic that everything is about streamlining and efficiency, and they're not going to be doing a whole lot of massive investment. They've got reserves in the ground. That's good for them. Price of oil goes up to $150 a barrel. They can borrow money at nothing. So there is a positive feedback loop for some of these bigger integrated players in the energy sector, but it doesn't necessarily mean that the upward pressure on the price of oil is going to go away. So there's that backdrop. And then at the same time, because of the little flinch toward possible extra lockdowns in the EU, there was like 4 sources that came out from OPEC Plus basically saying, they're not going to, they were going to increase production capacity this week, next week, April 1st, and now they're not going to. So they keep delaying this increase in production for OPEC, so it kind of keeps this tailwind in place. and the shakeout hit the right level, and so now I've got a small position on that I'll probably be looking to keep, and I'll probably keep that stop in the same place now.
All right. And do you have an upside target there? Or are you just going to let it ride?
I would say new highs, yeah. I mean, a breach of 70 at this
Oh,
point.
okay. So that's some pretty significant upside. Okay. Any other markets that you're dabbling in? Nothing in gold lately, Brett? Nothing
No,
there?
but I did see a positive dynamic in the tape today, it's the first time in months that we've seen rising real yields and what looked to me like a significant bidder starting to get involved. So it braced itself, interest rates go higher, real yields go higher. It's been a really, really negative correlation for gold. And it looks like there were a lot of sellers coming in and just hammering the bid, and somebody was just soaking it up. And that's a really good sign. So it may be that I move back into gold exposure.
Okay. And would you be most likely looking for a particular pattern, or is this one of those setups, Elliott wave type things that you were just describing?
I would probably just move in very small and wide initially and not worry about the short-term pattern.
GLD probably most likely?
Probably quarter position GLD with about a 5-point stop just initially, and then I can add to it in the future similar to what I've done in the past.
All right. I think that pretty much sums up what we had on the agenda for this strategy session and what we're looking to for the coming month. We got a lot of things brewing in April, and the quarter is about to end, so we got earnings season right on the horizon. So this will probably be the last time we talk about it until we are in earnings season full swing. Actually, it'll probably be towards the tail end of it. So we have put a lot of things on the radar for you. So I encourage you to go back, listen to what we had to say, go back and check out some of the names and get them all on your radar. We threw out some ideas in the SPACs. Gavin threw out a shopping list. The GLD talked about rotation. So there was a lot in this. So I encourage you to go back and check it out. I want to thank the traders for joining us today. I want to thank all the listeners for joining in and listening. We'll have this archived, so be on the lookout for that. And as always, thank you guys so much for joining me today.
No problem at all, Jim.
Thanks, Jim.
Have a good weekend.
You too. Thank you.